I hope you all noticed what I did this morning. I was kind of concerned when I came out here. Got up in the morning, I looked outside, and you know what I realized? It's a beautiful day for finance. We are so lucky to be here together today to talk about finance and accounting. I'm going to let you in on a secret, okay? Now I'd appreciate if this stayed in this room, okay? This is confidential. In finance and accounting, what we primarily do is we add and subtract numbers, okay? When we get sophisticated, occasionally, we multiply and divide. That's all we do. So the way we can confuse you and keep you from understanding what we do is we use many different terms for the same thing. You've probably been in this meeting, okay? I come walking in. I'm Joe, your finance guy. Hi, you guys, I just closed a quarter and I'm really concerned about our numbers. When I looked at our income statement, it was an awful number. And as far as I'm concerned, if we come in with a P&L to corporate like that, when they consolidate to their statement of operations, we may as well just go home. We're all going to lose our jobs. And you listen to it, you go, whoa, what did Joe just say? I said the same thing 4 times, okay? Not only do we use a lot of terms for the same things, but we interchange the terms. So if your finance or accounting people start using terms you don't understand, just say, hey, Joe, could you stop for a minute? I have a calculator. You'll notice it has all 4 functions. I can do everything you can do. Just explain the term. I promise the math is not that hard. We're going to get a chance to do some of the math later. I promise we can all do this. Now, people often say, well, Joe, what's the difference between earnings before interest and taxes? Now, let me just say something about that. The reason why we want to look at what we made before interest and taxes is because you all out in your offices, how many of you are involved in figuring out taxes? Does anyone do that here? Well, our CFO and some of our finance people do, but you don't. And so we don't want to put that expense in your income statement. How many people here are involved in paying interest on our debt and borrowing money? No one here. So we want to look at what we made before those expenses because that's what you control. Now, the reason why we put a DA on that, and I know this is kind of strange, we go to EBITDA, is because we want it to be obvious to you all. So we say, EBITDA is a key number. Duh. EBITDA. I know that's really weird. I know that's kind of strange that we do that, but it's just the way we approach things in finance. And let me say something as an aside here. It's hard to do jokes on EBITDA. That was a struggle, but we got it out. Let's define EBITDA for real now. EBITDA is an acronym, and it simply stands for this. Earnings, now remember, we could call it profit or income, what we made before interest and taxes, depreciation and amortization. Now, these are 4 expenses that you don't control. They're calculated, or they're the responsibility of others. So we want to know what we're making based on the things that we control and we manage. And that's why EBITDA is such an important number. Now, there's another reason why it's very important. It's a number that gives you an indication of future cash flow. Banks love the number. They use it in their loan documents. They'll give companies loans if they have EBITDA that meets a certain criterion. On Wall Street, they love EBITDA. In fact, back in the dot-com bubble, if you went to a party on Wall Street and you had your champagne, you'd walk up to somebody else and you go, when does your dot-com get to EBITDA positive? I don't know, when does yours? It was all about EBITDA. And how can we get more EBITDA out of the business? EBITDA is one of those numbers. Everybody wants to look at your EBITDA. We use EBITDA to value businesses. A lot of businesses, when we make purchase or when we buy a business, we value them by multiples of EBITDA. So, for example, if I was in an industry that traded at 5 times EBITDA, if my EBITDA was $1 million last year, it's a very likely chance that my business is worth $5 million. So this number is used in a lot of ways. Here's why cash and profit don't equal each other. First of all, we already established we recognize revenue or a sale not when we collect the cash, but when we provide the service, right? So we can have lots of sales, which translate to profit, and not have the cash yet, okay? Second, sometimes we count expenses before we actually pay them. If we buy supplies from a supplier for our office, we account that as an expense even though we haven't yet paid the supplier. They give us terms. And then third, if we spend our cash on capital, the cash is gone on the equipment we bought, but since we depreciate it over several years, we look like we're profitable and our cash is gone. So for all 3 of these reasons, profit and cash don't equal the same thing. Now my challenge to you is this. There are 2 or 3 key numbers on your statements when you get to office EBITDA that drive success. You should look at those numbers weekly if you can, monthly at least, with your people, and say, how can we get it better? Play games around it, drive it. Don't pick 10 numbers, don't pick all the numbers, pick 2 or 3. We have 2. Warren knows what those 2 are, and Warren is frustrated when he's not driving those numbers. I could tell you story after story of what happens when employees get empowered by understanding the numbers.
Joe Knight has enthralled audiences from 5 to 5,000 with his stories of financial management and mismanagement. Joe's easygoing style helps everyone understand the core financial concepts your people need to know in order to work, manage, and lead more effectively. His book, Financial Intelligence, was named one of the 100 best business books of all time. Bring Joe Knight to your people and watch them get engaged and even excited about finance.